Hello, everybody. So this is the Marquee DeFi panel. We have the three biggest names in DeFi here today, Hyperliquid, Ethena, and Aave. Let's jump straight into it. So one of the big stories this year has been about the stablecoinization of everything, right? So we now have a few examples. So for Hyperliquid, recently launched USDH. We've got Ethena working with Mega ETH to do MUSD. And then of course for Aave, you guys have had GHO, which is the Aave native stablecoin. Is this trend going to accelerate? Are we going to see every single DeFi protocol have its own stablecoin? And if not, what makes an ecosystem big enough or self-contained enough to have its own stablecoin? What are we going to see? Are we going to see consolidation? Are we going to see the everythingization of stablecoins? What's your take, Jeff?
So our take is pretty neutral. Like Hyperliquid is not one application, but it's rather it's a network. It's a community of people building. And so the motto is to house all the finance, though. And so when you look around at finance, the obvious bridge between TradFi and DeFi at this point seems to be stablecoins. So there's a strong prioritization. Like we view infrastructure and application as a bit of a blurry line. Like maybe we have core contributors are a bit opinionated on that. And to us, stablecoins, like building the best infrastructure for these stablecoins that ultimately, like you say, like consolidate liquidity and play out that way. We just want to make sure that Hyperliquid is the natural platform on which these things are built. So,
okay.
Yeah.
Guy, what's your take?
Yeah, I do actually think that week where we had the USDH proposal and the Mega ETH announcement that came out was actually a bit of a pre and post moment for this idea, where I can just say, sitting in our seat, we've spoken to pretty much every single major chain application wallet in the last 2 weeks who are now thinking about this a lot more seriously than they were before. I think there is a question around, is this the correct user-driven outcome that actually makes sense, which is like, do we actually need 1,000 stablecoins for every single app, wallet, chain? I think the answer is no. But I do think there is an incentive structure that means that you do actually arrive at that end outcome, which is if you own the user, if you own distribution, why don't you get more of the economics for providing that service? So I do think we'll see a structural shift in businesses like Circle, for example, being quite challenged, where existing distribution platforms do want to internalize some of those economics. And I think this trend is going to accelerate in a pretty aggressive way in the next few weeks. Yeah.
So you think right now we're sort of this expansion phase where everybody wants to have their own stablecoin, and then we'll see how many of them survive?
Yeah, correct. And I think to the question that you had around what is an appropriate platform to actually do that, I think a chain and an application are actually very different in the sense, because something like Hyperliquid does actually have the ability to have a bit more of a captive audience within its application to say, if we're denominating the pairs in this stablecoin, you have to use that stablecoin. So you have actually a pretty strong position to be able to force that outcome through. If you're a chain, you can't actually force applications or users to use a stablecoin, because ultimately, something that's built upon a chain, which is an app that actually owns the user, they might be able to make that decision or insert their own stablecoin. So I think there's different levels to the ability for these different layers within the stack to actually force that outcome through. And I think it might actually even create some tension between chains, apps, and wallets that sort of exist within the same stack.
Easier for an app, harder for a chain.
I think so. It's distance to user, I think, is kind of the important variable there. Yeah.
Got it. Stani, what's your take?
I mean, from Aave's perspective, the Go stablecoin was created more from user demand. So typically the interest rates in Aave markets are variable, so they fluctuate based on borrowing demand. And Go was a way to actually give predictable borrowing costs for the users. So that was the kind of like user demand for Go. And now that Go has been used by the Aave users, what we notice is actually Aave as a lending model, DeFi lending model is a very low margin business. So we have currently 70 billion worth of net deposits, 30 billion borrow volume. And with Go outstanding supply, for example, with 100 million Go, we're earning the same amount of 1 billion worth of external stablecoins. So it's a way for the Aave protocol to transition a bit to a higher margin business, 10 times higher from that perspective. And I kind of see these stablecoins also being a way of capturing revenue outside of the kind of like a core application infrastructure and being integrated into different types of financial applications and other infrastructures. And what we're focusing quite a lot is also in the As Go, so bringing a savings products for users. So all that revenue that comes from the borrowing of Go by the Aave users in Aave protocol, part of that revenue is allocated for savings products for Go. And that further can be integrated into fintechs and broader ecosystems beyond Aave. So it's one kind of a tool to increase the margins within the Aave ecosystem and also export the earnings that the Aave protocol is doing at the moment to be captured by anyone who is holding Go, where you don't have any lockups or cooldown periods. So for us, it's a more of a kind of like a strategic business decision and a way to actually export the economics of the protocol to beyond Aave.
Well, so a big part of the reason why the economics for stablecoins are so attractive is because of rates, right? So, it's been reported Tether's raising at a $500 billion valuation because they're just taking the rates, they're taking the Fed funds rate on top of all the assets that they have. For stablecoins, that's why they're compelling. But of course, DeFi was initially created when rates were basically zero. Rates have shot up now, and Aave's lived through this of both low rates, high rates, and low rates again. But for you guys have only really lived in a high rate environment. Rates are supposedly coming down. And now the dot plot says that, okay, Fed is going to keep cutting for some number of years. What does that do to your guys' protocol? If we're going to a lower rate environment, maybe not zero, but we're going down, how does that change DeFi from the perspective of your guys' protocols?
Yeah, so I think for us, it's kind of the biggest differentiating factor versus normal fiat stablecoin issuers, which is rates within crypto, DeFi, and then funding rates within CeFi tend to exhibit a negative correlation to rates in the real world. So saw the same thing last cycle where Fed fund rates went to zero, funding blew out to like 30 to 40% for 6 to 9 months in 2021. And really what's important here is like, what is the spread of DeFi rates to Fed fund rates in the real world? So for us, that's actually one of the biggest macro tailwinds that could ever exist for us, which is our competitors are seeing their gross interest income decline, very aggressively when rates come down. But we actually think the rate on Ethena's product either stays flat or sort of increases as froth sort of picks up within the market. So for us, that's like either an opportunity to extract more margin because you don't have to pay as much on the product to keep the users in there, grow more aggressively against people who can't afford to do as much with the interest revenue that they're generating. So for us, I think that's one of the most powerful tailwinds, and I think Ethena is probably one of the most reflexive assets to like a declining rate environment in crypto. Yeah.
So in other words, if you're getting yield from non-Fed funds rate sources, that's good for you.
Yeah, and I think it applies as well to Stani's business.
Yeah, Stani, how do you think about that for Aave?
I mean, when we've been looking at the data, so the Aave rates on average has been beating the T-bill rates. It's quite interesting for like being able to do that in a higher environment, but especially in low environment. And I think every single rate cut that happens by central bank, whether it's by the Fed or ECB regarding euro or pounds in Bank of England and so forth, is basically additional arbitrage for these DeFi rates. So I think as rates are going to go down, we're going to see a really good bull market for DeFi yield. And what it actually means is that we're going to have actually a situation where you can access to really compelling yield across globally, whether you are in the Western world, whether you are in Asia or LATAM or Africa, to that same kind of like a financial opportunity. And I think that's a huge thing. Last time when we had this low rate environment, that was basically DeFi before DeFi summer. And that's how the first adopters of DeFi came, because you had practically zero rates in TradFi. And at the same time, you had COVID. So people had a lot of time, to gamble, to go to DeFi and find these interesting opportunities if you're technically savvy. So now, we've built this really amazing DeFi infrastructure. Aave has been able to, work being battle tested for years now. You have Ethena, you have perps now with Hyperliquid. Like all that infrastructure exists at the moment, and we're going to go to a phase where DeFi actually can be embedded into like the broader financial and fintech system and distribute yields. And I think especially for fintechs and more like a traditional finance, once they start to seeing these rates going down, they will be the first ones that are actually looking for where we can actually replace their yield source and get the business back and create more stickiness for the users, because otherwise they will leave those applications to other activities. So I think it's fundamental for this kind of like a next really big cycle for DeFi yield.
So lower rates, more risk taking, good for Aave.
Yes, but I also would say that the Fed rates, or let's say the crypto DeFi rates, they're not fully uncorrelated. So there's some macro that really touches these rates. So
right.
Like all finance is tied together for sure.
I think just to build on Stani's point as well, I think when you saw the same dynamic last cycle, you didn't really have any connective tissue between DeFi and TradFi in any meaningful sense. So everyone was scrambling to raise like a credit fund in 2021 to find some sort of conduit through which dollars could enter the system. I think to Stani's point, you just have so many different surface areas now where that money can actually flow in, whether it's like DATs raising debt to actually come into DeFi to create a spread for the vehicle, whether it's ETFs and ETPs for some of these products that you can actually put into them, whether it's Stani's product sitting in the background of like a fintech Web2 app where you're just like back-end infrastructure for someone to like one click in. None of that existed last cycle, and so no one could really close that credit spread that we're describing. And so I think that this is actually like the largest macro tailwind for DeFi as a whole, and you can actually do it at mega scale now, where last cycle you hadn't really established that connective tissue between crypto and TradFi. Yeah.
That makes sense. Jeff, how do you feel about rates affecting what you guys do at Hyperliquid?
Yeah, it's not directly relevant to Hyperliquid in the sense that it's not, Hyperliquid is a set of protocols. I think that's a good point. I remember in 2020 that I feel like the reason the reason for the spread is just that the capital can't flow, right? Like markets are efficient. So yeah, I'm curious to see what happens this time. I guess I'd predict that like I said, the connective tissue is there. Like, I think Ethena basically, you kind of bootstrap from this lack of ease, right? This lack of like, capital chasing yield and like kind of not understanding how to onboard onto these crypto rails to capture this like obviously good carry trade. So I expect it to scale up, but I expect the rates to kind of converge probably. But that being said, I think like broader market, like I don't think there's a strong correlation, or correct me if I'm wrong, but like between general financial activity and rates. It's really just like more relevant to specific lending businesses that have beta to the rates. So I think like trading volumes probably go up is my guess, as volume and sort of asset prices generally correlated like over longer time horizons. And yeah, so I think finance happens regardless. Like there's genuine demand to allocate capital, and yeah, I think Hyperliquid is we're very like we build with a very neutral stance of just how can this just upgrade the financial system itself. Yeah.
Well, so Stani's claim is that demand for gambling, YOLOing goes up. I would assume that is going to be a buoy on any trading business.
Mm-hmm. I think so. Yeah.
Think so, probably. Okay. So let's talk about a little bit about what is coming next in DeFi. So right now, you guys are the three big things in DeFi: trading, stablecoins, lending. I remember back in 2017, the DYDX white paper came out, which was the original white paper describing perp dexes. And I felt like when I read that white paper in 2017, it was obvious that perp dexes were going to be a big thing. But it took until a year ago for that to really get realized by Hyperliquid at true scale that we see that's happening now. And so it was obvious then, but it took a long time to actually get there. What do you guys think is the next thing like that? The next it's obvious that it's going to happen, but it's not yet here.
For me, it's probably perpetual swaps on equities. I know you and I have
perps on equities.
Yeah, where Robinhood's business, right, is option flows on equities, and I think a lot of that is just retail saying, I want to get long leveraged on the underlying. I'm not actually trying to price volatility, price the Greeks of an option in doing so. And I think we can actually just look at the crypto experience, where I think like perp to options volumes are like 95% or even more in terms of the ratio. And so I think when given the option, retail users actually prefer a perpetual swap to actually express leverage views on the underlying. So to me, this just feels like a multi-$100 billion type of opportunity where you think that this is actually the correct form factor. There's demand for this kind of product where you can see it on crypto, and the asset base for US equities is 30 times the size of what we have within crypto. So I think it's basically Hyperliquid for equities is the...
Do you have a theory why it's taken so long?
It was extremely unclear if it's that like illegal thing to be doing within the US, I think. And I think my view is that like perpetual swaps within the next 12 months will become legal within the US. I think seeing Coinbase sort of launch, I think they called it perpetual style futures or something there in the US, was a bit of a tip of the hat in terms of their expectations for how quickly that does come within the US. So I think it's really just waiting for a bit of clarity around the regulations that becomes a viable product. Yeah.
Jeff, what's your take?
Yeah, I think perps are one of the great innovations to come out of crypto. I mean, maybe technically it was written in some paper before, but really was, like BitMEX and their sort of successors really pushing the technology and like refining it so that it's, I think, demonstrating that it's just in many cases a superior derivative instrument. And yeah, I think ultimately sort of regulation lags, but is driven by what is good. And I think TradFi, I think sort of, kind of ultimately is tipping the hat saying like, hey, like this is, like we can all learn. And just because the majority of the world's volume happens on dated futures now doesn't mean it's like set in stone as a rule or anything. And so I think perps, I think perps are, I think TradFi basically kind of coming on chain via, maybe unexpected sort of routes of tokenization. Like I think perps can be one of those, and it has a lot of benefits, right? Like I think tokenized RWAs like maybe haven't hit mainstream largely due to logistical issues. It's just tough. Like it sounds simple on paper, but every little step you need to do off chain, on chain, it just adds friction, and perps kind of also bridge a lot of that or make a lot of that not as necessary.
Okay, so 2 votes for perps on equities.
I think I just wanted to add to one thing that Jeff said. So I think one interesting feature of this as well is thinking about what happens when you move markets from 24/5 to 24/7. What's like the actual user behavior that you sort of create out of that. So if you think about like alt data that exists on equities, where maybe you're an equity analyst and you're checking if Jeff Bezos is going to like a club on Sunday night, which means you want to be short Amazon going into the week. Obviously, made up example there. You almost have a fiduciary duty to actually trade that information on the weekend when you have it, which is like, where can I actually access the instrument to put on that position? You have a fiduciary duty to hedge that risk or take a view. And so I think the interesting thing here is that if you actually force that outcome with perps to make this a 24/7 market, you're almost forcing demand to come into the market as well, which is you have to be expressing a view over those days that TradFi isn't actually serving a market. So I think that's actually a very interesting wedge for why TradFi would actually come and have to interact with this product rather than it even being a choice.
I would say it's not even specific to any asset class, right? Like it's really like the most efficient way to express a delta one view on
anything,
on a number.
Yeah.
So it's really like a core primitive. It's just like to me it's like a mathematical thing almost. It's like the markets should be efficient and should allow for efficient price discovery. And so
very Jeff answer. There's a mathematical prestige.
I do think we need to zoom out of it, right? It's not all about, at the end of the day, like finance is a lot bigger than any specific thing we see now, like hot pockets of money or something. Like broadly speaking, it's like human coordination, price discovery, allowing for liquidity providers to efficiently provide liquidity to the people who need it. So.
Beautiful.
Yeah.
Stani, what's your take?
Yeah, I think, I agree that the perps for everything might be interesting, and it's going to be growing the same way as derivatives are growing in traditional finance. I think tokenized assets also will have its place and grow as long as I think some of the kind of like restrictions could be more loosened. So I think that both of these form factors will live, and obviously derivatives will be like much bigger share of that. And I think that's how it's happened in the past in TradFi. And these are really great for especially like that kind of like a advanced prosumer audience. I think what's going to be also really big is just like taking what we have, all this technology, and trying to get it to the mainstream consumers. And I think what's going to be really big is to take yield actually to everyday people. And I think yield as a also kind of a product is easy to approach. And we probably see more of these ideas of what Ethena has been able to do, where you take some sort of a strategy that is happening natively on chain or a combination of crypto primitives, and being able to offer that to wider audience as a kind of economical opportunity. So I think like this transition part of like producing yield on chain and taking that to mainstream in a very like a simple form is going to be a really big thing. On the lending side, I think where we're kind of focusing also is to create more predictability. Fixed loans is one big topic that we're researching and working on, and also credit in general. Like how do you go beyond the over-collateralized lending model that you use some sort of asset as a collateral, and how you kind of like go beyond that and extend credit beyond cryptographic collaterals. I think tokenized assets is one direction there, but going more towards that direction. And I think being able to provide fixed loans is very interesting because you can create predictability both for the lender side, fixed income, and that is a really big market to actually bring on chain. And then on the borrower side, you can actually create a really good ways to hedge your interest rates at the same time. So I think that's a really fun area to focus on, and I think is going to grow significantly. And previously in DeFi, I think fixed loans haven't been able to really grow because the actual variable pooled models have been so efficient. So pretty much the pools on Aave are operating at roughly like 88, 92% efficiency. So there's very little optimization that happens there. But once you introduce fixed income and fixed borrowing, you actually are able to construct a very interesting credit products and investment products on top of this infrastructure.
Okay, so I want to switch gears a little bit. So the three of you, nominally, you're building trading, you're building stablecoin, you're building lending, but each of you also step a little bit into each other's lanes. Where Aave has a stablecoin, you guys are backing Ethena-powered exchanges, DEXs, and you guys have USDH as well as lending protocols within the Hyperliquid ecosystem. Are you guys becoming the new DeFi conglomerates? Like I remember once upon a time, people talked about sushi and Wi-Fi being like these DeFi conglomerates, but it never quite worked. But it feels like maybe now it is starting to work under you guys. How do you guys think about this? And what's the end game?
In my mind, like DeFi conglomerate is a bit of an oxymoron. Like it's, DeFi is meant to be, what is it? Like Legos, right? Like building blocks. People doing one thing, perfecting it very well and exposing an API that lets others plug into it and compose, right? And I think it was a bit of a meme, maybe like last cycle, it was more of an idea, but that's how these things go. But I think it really is playing out in real time. So like when you say, maybe some people disagree here on the vision, but for Hyperliquid at least, I think, we really value kind of core financial primitives being built on a credibly neutral platform. So for example, if you take spot trading, tokenization of crypto assets, right? That like any other conglomerate, which you might consider like centralized exchanges to be, right? They will view it as a core part of the business, a core part of the product offering and build it in-house. And on Hyperliquid, I think, it's people doubted initially that this was possible and that it would work. But I think it's early days, but I think we've kind of, as a community, proven that wrong. And I think this will just happen again and again. And I really think the original ethos of DeFi is the correct way to build finance. It's a lot more resilient. It's less, there are just fewer. When risks are isolated to self-contained components, it's just, you get less systemic failure. And I think that's just like that resonates with everyone, like TradFi or DeFi.
Yeah, I think part of the issue is that there's not that many business models within crypto that kind of make sense at multi-billion-dollar scale. And I think the three that you outlined here is kind of it, basically. And so if you're going to be expanding and trying to drive new revenue, you're naturally going to be stepping on the toes of people who are operating within those segments. I think from our perspective, we try to stay a bit disciplined around being the best at one thing for sure, and then like trying to think about these other things like after that. And I think sometimes you have the temptation to try to be everything to everyone and try to do a bunch of different things. And there's actually a long graveyard of history of, DeFi super apps, which are just kind of like the fifth best at everything that they do, and no one cares about them like in totality. So our view is like we want to try to do one thing extremely well. I don't think we've even scratched the surface of where we can take that one product. And I think we're not quite a platform like Hyperliquid in the sense of like an L1, but we do have like apps building on our core product. And we're not trying to internalize an exchange in terms of what we do. It's more giving our product and saying, do you want to build on this as a product to empower your own business and use that to build a product? One of them being on Hyperliquid itself. So I think it's just a slightly different direction, which is like USDH is sitting in Hyperliquid, but that's not their product, right? It's someone else's. But there is obviously some economic relationship between them building on top of Hyperliquid as a platform. And I think it's just us in reverse doing the same thing in a different direction. And actually one of those teams is sitting there on Hyperliquid to do that now. So yeah, I think to your question, part of the problem is that there's not that many places to make money in crypto, like at scale. And naturally, the biggest entities in the space all sort of converge to doing a bit of everything, whether it's a centralized exchange, trying to do their own stablecoin, trying to do their own chain and stuff. You kind of see this pattern repeats across pieces of the industry. Yeah.
But to Jeff's point, the delta then is that, okay, the CeFi conglomerates, they benefit specifically themselves. They're not necessarily open. They don't allow that connectivity. They don't allow that composability. In DeFi, we have that, but there's still going to be this cross ecosystem competition.
Sure.
Yeah.
Yeah.
Aave, sorry, Stani, how do you think about that for Aave?
Yeah. I kind of think in a way that actually Aave grows quite a lot because of because of these guys and what they're building, and I think that's a really big part of the Aave story as well, the composability, and I think collateralization is a big part of whole kind of like DeFi offering. So the collateralization and yield opportunity happens somewhere else. There's some sort of additional collateralization happening in the Aave protocol and the need for liquidity. And I think that Aave kind of like is a place to serve all these different types of innovation. And I think we probably will never see like Aave doing things that these guys do, because we benefit from that composability, and that's the kind of like a value proposition of DeFi, and why a lot of people love to build in the space, because you don't need to call different kinds of APIs. You can come just and build something really interesting and integrate all these protocols, and you have a product. And I think that's the really exciting part of the space. So I think we're going to focus and double down more on lending and just like figuring out how to manage more efficiently the collateral, how to tap into different opportunities, and doing that safely and securely. And that's a lot of work by itself.
So I want to build on that. If you remember back to the early days of DeFi, people thought DeFi meant, like, take MakerDAO v0, right? People thought that DeFi meant that everything is completely endogenous on chain and there's no connection to the outside world or fiat or whatever.
Oh yeah, we're past that.
Yeah, we very much passed it. Like, so you look today on Aave. Aave has Horizon, which is a permissioned RWA protocol. You guys literally have a product in partnership with BlackRock, and you guys have USDH is being issued by Stripe/Bridge, which is a big fintech. Like DeFi now very much is continuous with CeFi, right? This idea that like, okay, DeFi's over here, CeFi's over here, or not CeFi, but whatever. The external centralized world. It's very clear now there's a continuum that you guys are constantly navigating. How do you think about that? And are we going more in that direction, where there's going to be more and more of this interplay between the centralized offline world and the DeFi world? Is that vision of DeFi just over?
I think DeFi is fundamentally a technology. I don't view it as a different world. Like maybe it, by nature of previous years, it kind of feels like that. But I think ultimately, like what is a blockchain if not just a way for everyone in the world to agree on some state? And this is just a better technology for something so important and critical to human coordination as money and financial assets, right? So in my view, it's not like two worlds converging or like staying separate or competing or cooperating, but rather it's just the financial world updating their technology to something better. And I think better technology always wins. Like it speaks for itself. So.
Yeah, I think the version of DeFi that you're describing there doesn't really exist out of like maybe a handful of apps like still to today. And I think the issue is that like, there's sort of two user bases. There's one who really cares about those qualities of like pure decentralization. And I think that was like a very early user within crypto. And then everyone who's sort of come after that, I think is just a bit more pragmatic and practical to say, yes, there are qualities of decentralization that we find interesting or important. You don't have to do all of them, but we actually want this product to scale or have good UX and all these different pieces. And I think most of the successful apps that have actually come out this cycle have made some sort of compromise on that axis to say it's not going to be fully decentralized, but there is something else that we're trying to solve for here, which is scale or usability or whatever it is. So yeah, I think naturally that trend and direction that you're describing there will accelerate, because like if you're ambitious and you want to scale these things to like global scale rather than like serving 2,000 users who care about something being like Uniswap X times Y equals K level of like decentralization and purity. I just think the market for that is extremely small, and new people who are coming into the space have ambitions to build things that are sort of bigger and address sort of the whole world. Yeah,
I think the decentralization is kind of like somewhat wrong terminology to use these days. I think what really matters is resiliency, and the reason people cared about decentralization in the first place because it was able to bring resiliency. So being able to mitigate different kinds of single point of failures and And I think that's the kind of like a key behind of why we care about decentralization, and governance is also part of that. You can construct governance in a resilient way. So I think that's the key point. And when you look at just purely like what happened in the past few years, we had lending didn't really kick off in decentralized way. Like in DeFi, we started with ETH in 2017, and at the same time you had a lot of decentralized lending businesses, Celsius, BlockFi, Genesis Lending, raising hundreds of millions worth of funds and building the kind of like a crypto-backed lending model in a completely centralized way. And what happened, obviously, is that because these models were working as like a black box, unclear how the risk management was done, pretty much on a market cycle when it was coming down, all these centralized lending businesses pretty much exploded at that point. And if you look at today, the very few that are left that are doing from balance sheet lending or connecting peers, they're doing centralized lending, let's say crypto-backed lending at a 9 to 12% rates. Maybe you can find 7, whereas DeFi is actually doing the lending at 5% borrow cost. So what's actually happened is that virtually all that lending has moved mostly into on-chain, and you get a better efficiency on the pricing, and you have less actually operational expenses to run a lending business. So the conclusion here is that it's actually much, much easier for, let's say, a more like a CeFi or a fintech or a traditional market participant to offer this service, just plugging in Aave, for example, and offering that to their users instead of building this business from scratch and managing risk. And I think the reason the DeFi lending and DeFi in general did so well is because of the nature of the transparency, the smart contract-based execution, and all these properties that actually create better finance, and that is the kind of like an outcome. So I think what will happen is that we're going to go towards that direction, and we're going to obviously, and when you think about like these like centralized points, stablecoins by itself already are RDBAs, and we kind of like across that path. So we don't have necessarily all the properties of decentralized finance the same way as we had in 2020, but we have some of them that actually create better financial products. And I think that's...
Decentralization then is a means, not an end. And the thing you really want is resilience, reliability,
Yes.
dependability. And with these new systems, we have that.
Yeah, no one wants like basically like decentralization for the sake of like having a financial product where you have, I don't know, 10, 20 people arguing in governance. People want to actually like ensure that things work, it's resilient, and
Right.
you mitigate the risk. And if you can mitigate the risk, and if it's transparent, you can make better financial decisions.
Okay, well, let's talk about risks. I think it's a good transition. So if you look at some of the things that are now happening in DeFi, we have huge amounts of farming, looping. We have all these complicated Pendle strategies, yield stripping, LST, LRT trades, all of these things. And then of course there's good old stuff like, smart contract risks and forced liquidations and all this other shenanigans that sometimes happens in DeFi. What is the risk that you worry about for your own protocol? And it's crypto. There's always going to be a next blow up, a next big crazy thing that we all have to, shield ourselves from. Where do you expect that next big sort of uncharted risk to come from in DeFi? Jeff, what do you worry about the most for the Hyperliquid ecosystem?
It's hard to single
We can come back to you if you like.
It's hard to single out just one. I'm trying to think. Like, I think the biggest thing is, in my mind, like execution risk. It's not. I think like it's.
Oh, that doesn't count. No. I mean like a risk.
No, but I'm being serious here. Like it's easy to have like flowery images of kind of like black swan events, but if you really think about why things die in the real world, it's like why do not to be too morbid, but like by and large, like there are crazy accidents and whatever, but like by and large, people suffer from just like bad health. It's like really boring, but it's like if you look at statistically what happens, like it's kind of like a slow, painful death. And like I think that is in my mind the biggest risk. I mean, obviously there are a ton, like you said, there are a ton of like blow up risks, and like from that perspective, I think we try to guarantee like mathematical solvency in how the protocol works, as opposed to some underlying sort of off-chain assumption about something having backing or having some price or something like that. Like I don't think the solvency of any system, any well-designed system, should depend on things like that. And that kind of points back to the like DeFi or like on-chain vision being something that's like relatively self-contained and mathematically consistent. And so there's that side, but I think like by and large, like if Hyperliquid fails, I think it will not be. I think like by and large it will likely be because that we as a community like didn't build something of real value for the world. And I think like as things grow, it's easy to it's easy to kind of either rest on your laurels and think we just got to protect what is here, or think you've kind of made it, and like this kind of get that kind of hubris is a very human thing to feel. But I think that's in my mind the biggest risk. And maybe that's not really specific to Hyperliquid. That's more like for DeFi as a whole. I think there's like a super long road ahead. Like we've come a long way, but there's so much more to build. And it's not clear to me that like the space is going to ultimately like convince the existing financial system that it's worth taking seriously.
Right. Okay. So the sort of complacency and not taking your hand off the wheel. Yeah. Guy, how do you think about that for Ethena?
I think generally things are actually quite a lot safer than they were last cycle in many different axes. So I think even Vitalik was speaking about this 2 weeks ago, where he's talking about like smart contract hacks as a percentage of TVL basically just being in a straight line down since last cycle. So I think like from an engineering technical perspective, things are actually getting safer on chain than they were last cycle. I think the other piece around that is just around like systemic leverage that sits within the system is just not the same as it was last cycle, where you have a lot of opaque balance sheets that no one really knew how much was sitting in there. A lot of the genesis and stuff that Stani was talking about, the 3 arrows, all those different pieces. And I think this cycle is just very unclear where that type of leverage would actually be sitting in the system. And in a sense, actually, Terra Luna was a form of like leverage where UST was kind of like unbacked liabilities that were sitting within the system. So I think like everything across the system from like a technical engineering and like leverage perspective, I think is actually safer than it was before. The one counterpoint to that is kind of, we've seen sort of power law distributions in terms of how big these things can start to get. I think Stani is the best example of this, where I think they're up 10x in terms of the size of where they were in 2021 from like a balance sheet perspective. And these businesses and balance sheets on chain now are actually growing to like, you're the 39th largest bank or something, right? Or what's the number in the US?
33rd.
33rd, sorry, losing track. But like, these are like big numbers now. And yes, I think like as a percentage or like probability of like default and those kind of things trending down through time, these are just like very big numbers now where if something goes wrong, it's actually pretty ugly. So I think it's just more the scale that sort of gives people pause for concern. But it's also like why we're here, right? Like no one's here trying to build things which aren't systemically important. You should be excited to build something that's systemically important, but just doing it in the right way and in a responsible way. So I think, yeah, that's a general comment. And then maybe one other is just, I think Ethena kind of, we got a lot of shit when we came out, if you remember, in terms of like the risk, people being very concerned around how, Ethena would fit into the system. I think what we do now is almost like the safest version of what you could potentially be doing in a dollar format for this type of construction. But I think it's also opened up the Overton window for like anyone to just call like a loan to a Kenyan bicycle company, like a stablecoin now. And like, we're just throwing anything into a dollar and just saying like, this is equivalent. So I think I'll just maybe just ask people to sort of pause and think about things where we're starting to like push the boundaries quite far in terms of what we're putting into dollars and calling, in the format of stablecoin, basically. Yeah.
Stani, what do you think about biggest risk for Aave?
Yeah, I think I worry of all the risks, so that you don't have to, but but mainly because of there's just so many pieces in DeFi that you kind of like have to manage and keep an eye on. I think over the past years, certain risk categories have been decreasing significantly. I think smart contract risk is something that is, especially like all these protocols that have been kind of like proven after like year and so forth, that is maturing quite well. And I think more on the asset type of risk levels, that space is also maturing quite well. And there's really good risk service providers that are managing a lot of these parameters across lending protocols, have been doing really great jobs. So I think from that perspective, I'm kind of like less worried about as of today. I do think that, especially when it comes to lending, on the lending side, these protocols are actually tested out when the market cycle is going down. So it's really easy to get excited to list different kinds of assets on a market that is relatively stable or going upwards. But the true nature of the risk management is tested when actually the market cycle is going down and the liquidations are going to get into effect. And we saw over the past 5 years, over 300,000 liquidation events in Aave and 3.3 billion in total liquidations. And largest liquidations has been between 300 to 200 million. So it shows the resiliency that you can actually build in DeFi. And now I'm focusing a lot on the counterparty risk. So trying to figure out that if a certain asset is integrated into Aave, what is that counterparty protocol or asset risk? How is it managed specifically there? What kind of privileges there might be on that asset? And that goes to your point also towards that there's certain centralization elements involved, which might be on the smart contract basis, some sort of control functions or centralized functions. And I'm more worried actually about the centralized stuff because in kind of like a pure smart contract universe, you can actually like see everything and how things are codified in the processes. But then when it comes to these more centralized assets, there's something where we need a lot of visibility. I think actually credit to Guy and their team, they've been working a lot on, for example, transparency, and you can see a lot into what is actually happening under the hood. And I do think that this is one of the key kind of benefits of DeFi is that you really see how the sausage is made.
Right. Okay, so we're running up on time. We're going to end with a speed round. Going to get quick responses from each of you on a few questions, okay? So first, one word response. Who do you see as your biggest competitor? Stani.
The banks.
The banks.
Circle.
We're not building something that anyone else.
Okay, abstaining. Okay.
Abstaining.
One sentence answer. What do you see most DeFi founders get wrong? One sentence.
Oh, one sentence, not one
sentence.
word. Oh, I was trying to build it in
One
one word. Focusing on infrastructure too early.
Too much focus on infrastructure, yeah.
I think being too inward focusing on the small user base that exists just in DeFi and not thinking about
Small user bases.
I think composability, basically, not focusing enough on...
Not composable enough.
Yeah, and focusing on composability.
Okay, too low composability. Okay, now we're going to do overrated, underrated. I'm going to go down the list. You tell me if you think this thing is overrated or underrated. Okay, no abstaining this time. All right, you got that, Jeff? All right, first, tokenized stocks, overrated, underrated. Jeff.
Overrated.
It's like spot tokenized.
Spot.
Yeah, overrated.
Overrated.
Underrated.
Okay. Liquidity mining.
Underrated.
Okay.
Fairly rated.
Overrated.
Yeah. Overrated.
Overrated. Okay, interesting. Intense.
I say underrated.
Underrated. Okay.
Overrated.
Overrated. Okay, a lot of contingencies here. We're running up on time. I got a few more. Stablecoin chains. Overrated, underrated.
Overrated.
Okay.
Overrated.
Overrated. Okay. You hear that? Take that home. Non-EVM chains. Overrated, underrated.
No opinion. The tech doesn't matter. Neutral.
Okay, doesn't matter. That's even below underrated. Okay.
Underrated.
Underrated. Okay, interesting. And lastly, Arthur Hayes macro calls. Underrated, overrated.
Absolutely underrated.
Absolutely underrated. Okay, what do you got?
Absolutely underrated.
Sorry, Arthur. Overrated.
Was that overrated?
Yeah, I'm sorry.
Okay.
Overrated.
Okay. Does hype count as a macro call?
That's what I was thinking.
Okay, that's what you're thinking about. All right, that's it. Thank you to our three panelists. Appreciate you, everybody.